as of the close, and then we'll look at the weekly charts to finish off here. So very briefly today, as I mentioned, if you look at the top 3 listings on your market dashboard, you will see the story of most of this week, I would argue, which is the Dow up, the NASDAQ down, and the S&P somewhere in the middle. It's had some up days and some down days in the middle. The S&P opened much lower, obviously, and recovered back to finish just above 0 for the day. So it really was a barbell of sorts from the haves and the have-nots, if you look at it. So technology, the worst sector out of the 11, followed by communication services. On the upside, very defensive. You had REITs and utilities as the first 2. Industrials there, number 2, and then financials, number 3. These are going to chop around a little bit as we process the closing prices here. Mid caps and small caps, both with a decent day. And as we've talked about in previous shows and many times, right, when you look at small caps over large, that doesn't always just represent that investors are making a conscious small cap over large cap decision. Remember, it also reflects sector weightings, it reflects high beta and low beta. There's a lot of things that a small cap index means in terms of risk on and others. So certainly, 0.9% for the small caps, almost 1% up for the mid caps, definitely outperforming the S&P, which was flat for the day, and the VIX back below 21. Very briefly on other asset classes, yields continue to go back higher. So, this whole thing on the market, is recovering because yields are taking a breather. I don't buy it, because a day like this, yields are going up and stocks overall seem to be as well. So I don't think that's as one of a relationship as some might suggest. And we're back above 1.6%. The TLD has come off a little bit. The dollar index up about 1/3% today. Gold actually got back to flat. It opened up pretty low, around 159.50, but chopped its way back higher and finished flat for the day. Silver, though, finished down a little bit as well. And energy stocks flat to up a little bit on weaker oil prices. Cryptocurrencies, for the most part, down, with Bitcoin down 2% after being much lower earlier in the afternoon. Let's go to the weekly wrap chart. That's this one right here, and the labels may be a touch off, not too bad, but we'll see how we can update these. So basically, this is looking at some of the major asset classes. I like to start with the S&P 500, which is right here. Finished the week about up 2.7% from last Friday's close, where we're at right about now. Most things underperform the S&P, and that speaks to sort of the underperformance of other asset classes versus stocks this week, is what it essentially tells you. In pink, I missed one label here. Sorry about that. That's actually the NASDAQ 100, which was up 2.2%. Gold was up 1.5%. Emerging markets up of 0.25%. If you missed my conversation with Dana Lyons, I want to say, we were talking about emerging markets and a potential bounce. So I had not been paying as close of attention to that chart before our conversation. I'm certainly keeping an eye on that one. Crude oil flat to down a little bit today, 0.2% below 0. The dollar a similar amount, and bonds were the worst of all the asset classes we follow here, down 2%. That's just using the TLT as a proxy for bond prices. What outperformed stocks? Just 2 things. The small cap index up 7.4% and Bitcoin up 16%. And we talked in yesterday's show about an aggressive, but probably less aggressive the further we go up, upside target for Bitcoin, given a break above 58,000, which it did not do. It touched it yesterday, did not get it back above there today, but I think a break above 58,000 takes us up to the upper 70s, if not 80,000, not too far off, given the trajectory. That's another 20-25% above where we're at now, I would guess. Let's continue on looking at the Mindful Investor live chart list. This is what we look at every Friday, and it's sort of our big picture review of key themes out there. If you want to have this list, you are welcome to take it and copy the charts to your own watch list, do whatever you want with them. The way you can find this is go to the articles page. In the upper right, you'll see.
Over the last few months, Americans from all walks of life helplessly watched our economy come to a screeching halt. Businesses were forced to shut their doors.
Right, you'll see all stock charts blogs. Click on that and go to mine, which is called the Mindful Investor. And at the top, you will see a link, a little gray button that says live chart list. And you can click on that, save the individual charts, tweak them, edit them, do whatever you want. They're yours to enjoy. We'll start with the market trends. So I use a weekly chart and some exponential moving averages to determine a long-term, medium-term, and short-term trading model. And this is basically a long-term trend following model, really. I didn't update the label just yet. I do usually do a Friday after the close, but the short-term model had been negative for the last couple of weeks, with this week's bounce higher really driven by the value parts of the market. The short-term indicator will go back to bullish as of today's close. The medium-term indicator will continue to be negative, will be bearish, and the long-term indicator remains quite bullish. And to be honest, if I didn't have this in front of me and you asked me to tell you what the market felt like, it's pretty much how I would answer it. Short term, you can't deny the bounce that we've had this week. You can't deny the strength in a lot of individual charts out there making new highs. That's totally fair. Medium term, though, I think the weakness, the divergences we've had, the stocks that have sold off and really haven't recovered yet. And it's a lot of things. It's not just the mega cap tech. It's also things like Peloton and Zoom and others, trying to revive a little bit, but still nowhere near the high flying scenario that we saw a month ago. So I still think the medium-term picture is mixed to down. The long-term picture remains very, very strong. And any week where we make new all-time highs, that indicator very deservedly should be in a positive. So that's about how it feels like in terms of where we're at with the divergences, with the long-term trends, and with the short-term bounce that we saw this week. I think that's about right. So the daily chart of the S&P certainly looks encouraging. It's hard to be discouraged by what you see here. I will give you the bearish argument because I've thought through it in many cases. And you probably hear from my language. I try to address things from as unbiased a perspective as possible. But obviously I'm an analyst, and I'm analyzing charts for clients and for many people all the time. So I always sort of have an opinion that I'm working off of. But one thing I learned over the course of my career, especially working with a team of technical analysts, was it always helped to have someone argue the other side of it, even if you all agreed in one outlook. Have someone take the other side of the argument and just consider the other side. So overall, I would think things are setting up very nicely for the S&P itself. Made a new 52-week high, a new all-time high yesterday. Did not repeat that today, but closed higher than yesterday. So a new closing high for the S&P to finish the week. That's pretty impressive. We have not yet broken above the, really meaningfully above the high from mid-February. So I think at this point, that is a key level of resistance. And the fact that we met that yesterday, sort of repeated it today, that is really the line to look at. We break above that. And again, I'm not struggling to find good charts out there. I think there are plenty out there. It's all about continuing to follow trends until they tell you otherwise. So we had, what could have been a major league head fake with the S&P getting below its 50-day and then reverting back above it. We'll have to see if we can eclipse this and go to new highs. In terms of other things that are concerning, what is encouraging is we bounced off RSI 40. That's when we pulled back to around 3750. That's pretty encouraging, actually. That's what a bull market should look like. But the problem is, as we're making new all-time highs, the RSI is much lower than it's been in each of these previous peaks. So what happens is every time the S&P is going higher, there's less momentum behind it. That's not super encouraging. You'd want to see an increase in momentum if you feel optimistic about dramatically further upside from here. And that's where I sort of look at it. It's not that I don't think the market can go higher. The question is, can we go significantly higher? I'm doubtful of that. What does not make me doubtful is the strength of the trend measured by the cumulative advanced decline lines. If you look at the AD lines for these four major lists, common stocks on the NYSE, the large caps, mid caps, and small caps, they have all made new highs this week. A mentor of mine may have said, and if not, I probably am combining a lot of their guidance over the years into one quote, is don't be bearish when the advanced decline lines are all making new highs. That's kind of what I might tell a mentee of mine on a day like today. And so that's what I'm seeing. It's hard to be negative when you see this chart continue to go up. That tells you the market's in an uptrend and not to question it. You're also seeing an expansion of new highs. And this at times has been, part of the exhaustion thesis for me in January was an anemic number of new highs. We've seen that revert back upwards now. So now you're seeing, a decent number of new highs. Yesterday, you had, 15% of the S&P make a new 52-week high yesterday. On Thursday's close isn't updated for today yet, but that number may even go a little bit higher. That's pretty encouraging. That's expanding new highs are a healthy market. Less and less stocks similar to the RSI and lower momentum on upswings. You also have less and less stocks above their 50-day. But I think what's worth noting for me today is that in the last week, we went from 50% of the S&P above their 50-day up to 74% or 73% as of Thursday's close. That means as the S&P itself has gone below its 50-day, dipped below it, and reverted back higher, 25% of the index has done the exact same thing. That's pretty encouraging. Quick look at sentiment, and we talked about this really in detail on Thursday's show. So if you missed it, go check it out. But AAII bullish reading back up to 49%, very close to euphoric reading, but not quite there. The real story, I think, is the name exposure index, which has gone down from about 108% 3 weeks ago down to about 48% this week. That is a huge swing. It shows you that active managers are definitely tapping the brakes, if not stepping on them altogether. A lot of other things I could show you in rapid succession before we take a break are risk on versus risk off. And to summarize, they're all saying risk on. Equal weighted consumer discretionary over consumer staples. Relative strength of semiconductors, certainly not confirming that is one that does not agree with the bullish thesis, but small over large, that's a check. Equal weighted over cap weighted, that's a check. Growth under value, that is the truth. So these themes that we've seen starting to play out have continued to emerge. And again, there's enough stocks going up that it's able to digest the FANG stocks and a lot of technology names not doing so. We need to take a quick commercial break. Back answering